Hi. On June 5th and 6th, 2024, I'll be speaking at the largest AI event in Asia, Super AI, in Singapore, at the iconic Marina Bay Sands. Alongside brilliant minds like Benedict Evans, Balaji, and Edward Snowden, I'll be on stage exploring the extraordinary potential of AI and the profound change it represents not just for financial markets, but for the world as we know it. With over 5,000 attendees and over 150 side events, Singapore will become a vibrant AI hub for a full week from June the 3rd to the 9th. Visit realvision.com/super AI to register and join me with 20% off tickets with the code REALVISION, all in caps.
What can derail the Nvidia train? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Eric Johnston, head of equity derivatives and cross asset at Cantor Fitzgerald. Hey, Eric, great to see you again.
Maggie, how are you?
I'm doing well.
Good to see you.
Yeah, it's a good day to be on. We're just talking about how busy you are because Eric looks across all asset markets and there's been so much going on. I really feel like it started even at the turn of the year, Eric, and it continued through. But we've been talking about volatile markets, good for business, a lot of opportunity, a lot of risk to sort through. But today it looked like all the opportunity. U.S. stocks up across the board, new records for S&P 500 and NASDAQ, led once again by Nvidia. I mean, the momentum around this stock is incredible. Up nearly 4.5% today, and into the close, it was like jumping 0.5% every half hour because I was watching it. 15.5% gain in the last 5 days. And if you look over the last year, it's like almost 300%. I mean, these numbers are just crazy. I joked with you, is this the thing that everyone asks you at cocktail parties? And yeah, it is.
It is.
I mean, can it continue? That's what we all want to know. I mean, can this thing continue like this?
So it can continue. You know, they're fundamental. It's very much like nothing we've really seen before in terms of it's not just the stock price, but the exponential growth that's happening in their fundamentals, right? If you look at their revenues 2 years ago, right, they were doing 25 million. Their revenues have gone up exponentially, and there's a case to be made that this type of growth over the next 6 to 12 months, the pace will slow down, but the magnitude of the recent beats can continue because they are the absolute epicenter of the AI infrastructure build out, and not in the entire semi space to a lesser degree, but as part of this build out. And I think that as the market looks at AI, there are some things that are more certain than others, and right now we're in this build out of these models, and that is highly likely to continue for a long time to come. The variability will come around the products, the productivity gains, the impact on society. All these questions, right, are huge unknowns. But for right now, it's all about the build, right? And so governments, the cloud providers, and everyone else are gobbling up these chips. And at the moment, they're really the only game in town. And so they have 76% gross margins, which is pretty epic. And they're probably going to be the only game in town for some period of time to come.
Wow. I love the idea of the infrastructure build out because there is a tendency, and we always talk about recency bias, and it wasn't that recent, but for investors, everybody kind of thinks, oh, we're seeing these extraordinary gains. It's like the .com blow up. That's what comes up all the time, right? It's all of these gains. It has to be a bubble. It feels like a bubble. But when you're talking about something like infrastructure build out and revenues that have increased so much, those are some fundamentals under what looks like it's also a really powerful momentum stock. That's a kind of different narrative to think about.
Yes, I mean there are some similarities, but mostly there's a lot of differences between this and the late 90s. So I think it's when your sample set is so small of anything that's even close to this, right? The first thing you're going to go to is the dot-com bubble. But I think that this is a much different situation because, as you said, the fundamentals and the earnings are actually there, as opposed to, in the late 90s, some of the multiples were a lot higher, and many of these companies were not profitable. And so there, within the market currently, there is clearly speculation going on, and there are companies that are, likely have prices and price to earnings ratios and expectations that are far out of bounds. But I think for someone like Nvidia, the fundamentals have been there. And I think the real question going forward is, number one is it's getting to be somewhat of a crowded trade, right? The momentum factor in the equity markets is crowded and it's very overbought. And so that does present, from pure supply demand perspective, that does create some short-term risks where, if you do get a turn, then that could have some legs. So one thing I would point out is, if you look at Nvidia options, so right now, if you go 3 months out, the calls, the 25 delta calls, are about 5 vol points higher than the 25 delta puts. That is highly, highly unusual, right? Because typically, when you think about where the gap move can happen in a stock or in the market, it's typically to the downside, and hence you're going to have people are going to pay up for that protection. In this case, right, the crash risk that people are worried about or are betting on is to the upside. And so that kind of gives you a sense. And if you look at a chart, it's the highest, about the highest it's ever been. That gives you a sense around how people are currently thinking about it. And no matter what the stock is, whenever you get people that are thinking that all in one direction, that does create a risk.
Yeah, that's that's really interesting. So the bull case, which seems like it's a little bit of a longer time horizon, the fundamentals that are supporting this, there are some fundamentals, and there is a narrative, about this infrastructure blowout. But from maybe a shorter term perspective, or from a technical perspective, there is reason to worry that you could see that it's just that everyone's on the same page. And whenever that happens, if there is a down move, you're going to get a lot of people caught out on that. Is that what you're telling us?
That's right, exactly. And it could be nothing related to the fundamentals. It could be one small data point from another semi company or something that's out there. Johnston gives a keynote speech on March 18th, which is expected to be very positive. And so, but expectations are certainly very high. And so in the short term, that would be something that one can think about. And then, of course, in the long term, there's questions around, will they be able to maintain these types of margins? Will new competitors, come in? And the big variable that we really, don't know is the surge of buying going on of their chips to go into the data centers. It's very hard to predict, right, the path from here, right? We've had all this surge in orders, but what is that going to look like in 6-12 months? Maybe the surge continues. Maybe you get some sort of slowdown along the way.
Yeah, maybe they're hoarding, right? Maybe they're stealing from the future because they're worried about supply chains. Maybe we've seen that,
Yeah, that's a question. Yeah, that's certainly a question, and that's out there. But but certainly, the fundamentals have certainly been there in a big way.
So it doesn't, I mean, we never give financial advice. We can't tell anybody what to do because we don't know their risk profile and when they need the money, et cetera. With that disclaimer out, does it seem wise to take profits when you see this kind of momentum, or is that kind of the wrong strategy? And do you need to think about sort of leaning into momentum? How do you think about dealing with a stock that's moving like this?
So, for Nvidia specifically, that's a hard question. That's a hard question for me to answer. I don't have a strong view. What I would say is that the momentum factor in general, I think, is quite crowded right now. And you're seeing that, for example, in the SMH. SMH has gone parabolic. Nvidia is 25% of it, but semis in general have sort of gone also, parabolic. And to me, that presents some risk. And I think when the SMH does turn, the sell-off is going to be sharp, where because it is a crowded trade, and all of a sudden it's going to be, ticking up, and then one data point can come out and you can see a quick move lower. So I would be, wary of that for sure.
It's a semiconductor ETF for those of you who are following. So when we're looking at, I want to stick with tech for just a minute, because we all know the Mag 7, right? There's all this keen interest, and there was a lot of worry, but it's been fueling this huge record ride. We've seen a change now because Apple, Tesla really struggling. Are we in a different environment now? Are we going to see a divergence between this sort of AI related stocks and then maybe some of these other mega caps? Is that notable? Is it something we should be paying attention to? How are you thinking about the Apple in particular?
Yes. Yeah, I think it's a massive change. Our view has been, we've been bullish on the Mag 5 and have been negative on Apple and Tesla. I actually am of the view right now that Apple is a short-term buy, which we can get into, but correlation in the market overall has fallen sharply. It's down to about 22. And so there is dispersion that is going on across the equity markets, which we're very happy about, presents, opportunities. But dispersion has gone up a lot. And so it's not only within the Mag 7, but really within the whole market, people are picking winners and losers. And so you have these secular growth themes, whether it be GLP-1, whether it be AI, or whether it is related to fiscal spending, so some of the CHIPS Act, et cetera. Then on the other side of the coin, you have those companies that don't have those secular tailwinds and maybe have higher debt levels, are smaller cap, are more cyclical, present more risk, or are selling products, particularly in tech, that could get, where the buying of the technology infrastructure in AI could actually take away from spending elsewhere, and they could be hurt by that. So there's really a bifurcation going on in the market. To your question about the Mag 7, Apple has been under significant pressure, and they haven't come out with a AI strategy yet. They're scheduled to at the Worldwide Developers Conference in June. And the multiple has been very high, considering that their growth has been zero for about a year and a half. Their estimates have come down, and yet their multiple has been in the high 20s. And so finally, that has now re-rated lower. And so now you're talking about a multiple that's more 24, 25. They at least have announced when they're going to be talking about their AI strategy, but there's a lot of questions around can they really have an impact? Are they really late to party? And then the kicker with Apple is that they've had the data points coming out of China have been very weak, and Huawei taking share. There's some nationalism going on there and other factors. But the magnitude, I'll give you one stat, the magnitude of the sell-off is pretty historic. So if you look at Apple relative to the S&P 500, that's the way we look at it, the RSI is down to about 12. So over the course of the last 30 years of Apple being around, that is the lowest RSI in its history. And just to give you a magnitude of how much of an underperformance this really has been from Apple.
Wow. That's interesting, and that's going to make some people think. But it's hard, because we feel like we're in this environment where there is so much that's new coming with AI that, can you keep getting the repeats of the past? A lot of people are kind of thinking about that, or is this a change in the guard? That's a tough one. So
and it's also, I would also say Google has also been an underperformer, and there's going to be, when we talk about products, that's where, and I was mentioning earlier, the variability.
Mm.
But we don't know what search is going to look like in 1 to 5 years. And Google has over 90% market share in search and is obviously quite profitable. And so now the market is starting to hit their multiple because of this uncertainty.
Yeah. Because the existential question is, just because they're late, are they late and it's the beginning of a different era, or are they just waiting and they're going to get it really right because they have the right
Yes.
management, and then they end up having the kind of killer, the killer app or the killer functionality, and they've just been working on it behind their Silicon Valley walls.
Yes.
That's the thing that I think we all flip around on, especially since both of them have a history of doing exactly that. So, but who
Absolutely.
knows, right? That's the
Yes.
crystal ball we don't have. When we're talking about dispersion and broadening out, I'm wondering. So obviously, we've been talking about a lot about tech and about Mag 5. It's where the momentum has been. A lot of people sitting in those names or have some exposure to them in their portfolios or their retirement. What about the broader S&P 500 or even the Russell? I think that you've been watching that, and we'll have people on who say like that is an indicator for them, like the performance of the Russell, and if they're participating, if they're moving higher. Would you expect to see in the picking of winners and losers and all of that now? Would you expect to see opportunity there, or is that just because of maybe the rate environment tricky? How do you think about the broader stock market?
So I think around the Russell, we made a tactical bullish call about I guess about 2 weeks ago.
Mm,
But I think it's really going to be a trading vehicle and can get trading bounces.
mm.
But I don't think it's going to be something that you're going to want to be just persistently long relative to the S&P 500. So there's still a large portion of the Russell that is not profitable.
Mm.
It is higher exposure to financials, has higher leverage, and we can get into this, but I think that rates are going to stay higher than the market would hope for, or that would be something that would be helpful to the IWM. So if you're going to have higher rates, which I think we are going to have, then and you potentially have some cyclicality risk, then IWM is probably not where you want to be. Having said that, why do we make the tactical case? Because it's been a huge laggard. People are looking for, in a market where sort of everything's rallying, people look at, okay, what hasn't moved yet? And also, what is less crowded? So
Mhm.
if we were to get a momentum unwind that I was speaking about earlier, that would actually benefit something like the IWM, because that's not where positioning is crowded. That's not where people have piled into, and that could actually be helpful to the Russell 2000.
Yeah. I think it's a great point about the leverage and the rate environment. So we do have employment numbers tomorrow. What is the rate backdrop? I mean, do you think that we had Powell saying today, inflation's moved lower than we thought it was going to, and that's been a surprise. He did keep the door open for rate cuts, but he keeps emphasizing that they're not in a hurry. What makes you think they're going to be higher for longer?
So it's interesting. Yeah, he was, fairly, on the margin dovish today.
Yeah.
If you think about what's going on right now, if you look at inflation break-evens, so 5-year inflation break-evens, which are right now about 2.4%, they're close to a 1-year high. And you have financial conditions that are the easiest that we've seen in the last couple of years. You have gotten a couple inflationary data points, only 1 month, but that showed an uptick. And you still have an unemployment rate that's 3.7%, and you have an equity market that is showing a lot of exuberance with new highs, Bitcoin going parabolic, etc. So if someone just told you that environment and you didn't know anything else about what the Fed has said or what the rates market is pricing in, to me, it's not necessarily an environment that you would expect the Fed to be cutting rates. And so while, they're talking about how restrictive policy is right now as inflation comes down. That gap is widening. Totally get that. But I think there is risk that as they go into cut mode, which they made very clearly, the first cut is really important because it's not just going to be one, right? It's a signal of a trend that once you get that going and you have this exuberant markets right now, that could be a very tough combination that I think presents risk of inflation moving up again. And
Yeah,
so,
which is why it was interesting that he kept the door open on rate cuts. But he could have easily just said nothing and just said, we're going to watch and be patient, which would have been a bit more hawkish. So I
yes,
was surprised that he even introduced that idea because that's been
right.
the issue all along. You bring up a good point, though. We have seen stocks going up, Bitcoin going up, bond yields were down after Powell's comment. That doesn't seem consistent. Somewhere along the line, or can all these things rally at the same time? What does that tell us?
Yes, so it's an everything rally. So literally everything from bonds to the other end of the spectrum, crypto, gold, stocks, credit is at its tights, absorbing a significant amount of supply year to date. So it's been a buy everything. And I think that one of the factors that could account for that is that there is an expectation, which is certainly our view, that QT is likely going to tail off, that they're going to wind it down, start talking about it possibly or likely in the March meeting, and that they will wind down QT over the course of the next 6 months. And so I think that winding QT to zero, the next step, not right away, but the next step is launching QE. Because ultimately, the reason why they are going to be ending QT is not because they necessarily want to, but because they have to, based on the supply and demand dynamics that are out there in the debt market. And so I think that down the road, the market is also thinking not only they're going to end that, but they're going to have to start buying bonds to monetize the debt
So this is not end of QT, start of QE because of the economy or because of
no,
some financial break. This is because they have to manage the debt.
that's right. I mean, it's the choices for getting our debt under control, raising taxes, cutting spending, or monetizing. And I think it's pretty clear that the first two are just not going to happen. Not anytime soon. So you're
No
in
less than an election year.
right, correct. Election year, and certainly both platforms of the two leading candidates at the moment are for anything around touching entitlements or touching spending or anything of the sort. So it's going to have to be the buyer is going to have to be the Fed because certainly our interest costs continue to rise. They will continue to rise, and there's no cut to spending.
So against that backdrop, there is no reason to think anything has a pullback, right? Because we're looking at and if we layer on that for global watchers, a feeling that China is going to be forced to stimulate their economy, then why would any of these assets go down?
So I think, over the long, that's a very fair question. And now these asset prices would go up in nominal dollars, would not perform as well in real dollars. But I think in the shorter term, one of the things that you do have to worry about for equity markets are there's a number of things, but one of them is the multiple.
Mm.
And the multiple has the average multiple has been in the mid-teens going back since the beginning of time, and it's been very rare cases where you've seen multiples of 21 times or greater, which is where we are now on forward earnings. And so going back to your point about the dot-com bubble is in 1997 we were about the same multiple as we are now. And so if you bought in 1997, you clearly did very well in 98, 99, but assuming that one just held on, which most people did, 5 years later, your investment was actually down in nominal dollars and was down a lot in real dollars 5 years later.
This
And
is
so,
exactly the fear that every single person listening has, Eric. You just explained why we all obsess. And I was joking, Eric's tortured at cocktail parties because that's the thing
yes.
everybody wants to ask him. But it's true. I can imagine because this is our fear that people are looking at these really nice gains in their retirement and just think this thing could go and I could just lose it all when I'm going to need it.
Yes. I mean, even if we, and then, it's always hard to know when to get out. So let's say that the S&P goes to, 5,700, 6,000 in the next, year and a half. If we then have a correction that say is 20%, which is a normal sort of correction, especially with the multiples that we'd be talking about when we get to, getting to 5,700 or 6,000, you get a 20% correction and from 6,000 and you're down to 4,800. And all of a sudden you look up and your 3-year returns, while you had some years where you felt really good, ultimately your returns 3 years later from where we are today are not good. And the reason was because your starting point was this 21 times multiple. Right now we're trading, if you assume 10% earnings growth in 24, 10% in 25, and 10% in 26, and I said that's guaranteed, we're trading at 17 and a half times 2026 numbers. Right. And so that's what really presents the risk, where if you get any sort of shock, economy rolling over, et cetera, that's where you really have risk.
So that was my very next question. This is such a fascinating conversation because to understand the rally, you have to put the fundamentals aside and really focus on this, monetization of the debt, because that's what's driving it. The problem is you can't forget about the fundamentals because it sounds like what you're saying, fundamentals and/or a shock could kind of force themselves back into the equation and be the catalyst for some kind of sell-off or some kind of pullback.
That's right. And I think we're also, we are late cycle. Now, late cycle doesn't mean it can't go on for another 2 years. But when you think about where the unemployment rate is, it's at the bottom of the historic range. This is the second longest period of time that we've been under 4%, for this long. And, at the output gap in the economy we're basically at a full economy. And so now debt levels are very low. And the consumer has been flush with cash still from COVID. But that's one thing to be concerned about, is just that, are we going to stay at a 3.7% unemployment rate for another year, 2 years, 2.5 years? And even if that recession comes in that 2026 period that I was talking about, from 6,000, you could chop 20% off from 6,000, and then all of a sudden your investment's not looking very good.
Yeah, nobody wants that kind of drawdown. We got some questions coming in about crypto. We mentioned it. I love this as a sentiment. Ask an analyst, especially someone like Eric, who has a view on across all assets, what he gets asked the most about, and that's a good sentiment read for you. And you told me Nvidia and Bitcoin right before we came on air. Ralph is asking, are you seeing anything in the crypto derivatives space? But just generally, how are you thinking about what we've seen and the fact that we're now in this world where there are ETFs around Bitcoin? How are you thinking about the crypto space?
I think that was a big change, was the access to be able to trade in your stock account. And I just think that that's a monumental change in the crypto space. And when it first happened, initially there was a lot of buildup. Then we actually got the official announcement. Bitcoin moved higher for the first few days, and then actually retraced, and then was below where the official announcement occurred. And then, of course, from there, it's been straight up. But I think the ability to hold this ETF has just given access to just a far larger group of people. And we are currently, the environment right now is ripe for speculation. And and momentum. And so that's what's going on. I can't say I have a strong view around, where it's going to go in the short term, but I think that this is the environment. This environment has been just the perfect combination between the ETF approval and the overall environment.
And risk on, right? And risk on and
That's right.
the everything rally. What about gold? Because it's kind of funny in this universe when we're talking about the everything rally. Probably the best example of that is that you have digital gold, what people want to refer to as digital gold, and the actual gold, which seems to be finally breaking out.
Yeah, so I think part of it's sort of the laggard trade where people are looking for, or we're looking for, what hadn't moved yet, and really silver and gold really had been stuck. And so I think it was a situation where people were seeing what Bitcoin was doing and seeing what other asset classes were doing and say, oh, okay, this hasn't moved yet. Let's move there. And then once it gets the momentum going, as it did, people just piled on.
Yeah. I'm not sure if you're watching this. Chet is asking if your thoughts on the reverse repo. It's been draining steadily, providing liquidity to markets. Any implications short term, tax season also coming?
So two factors. So the reverse repos, and then I can also speak about the TGA. So the reverse repos, last I saw, I believe were about 420 billion, on their way, but very likely to zero. And probably by maybe the third quarter of this year. And so I think the concern there is, as reverse repos go lower, there's a lot of concern about bank reserves, and I think that this is one of the reasons why QT is going to start to roll off. I think the Fed is definitely watching this, watching the move there. As far as the TGA goes, it's right now at about, I think it's around 750 billion. It's been pretty steady there. One of the big questions is, into the election, is Yellen going to draw that down in order to add liquidity to the system? And that can be done. And so that's something that I think people are watching. And if you just think about, if she were to draw down from, say, 750 to 250, and were to do over the course of 3-4 months before the election, that could add $500 billion of liquidity to the system. And so I think that's as everyone does their calculus around how the next 9 months are going to play out, that has to be in there as a possibility. And we don't know whether that's going to happen or not. It's really sort of in her hands.
Yeah, these are wild times. Eric, such a great conversation. You do such good work there at Cantor, and it's so nice to have you on today so we can sort of get a view across all of these assets. And really, you really helped us understand. I think some of it is counterintuitive, but there's a lot going on underneath the hood. So thank you for pointing that out for us. We appreciate it.
Yeah, Maggie, thank you very much. Really, really enjoyed the conversation.
Awesome stuff. We will be back. We, of course, have employment tomorrow. We're going to be talking a lot about some of the stuff we just talked about with Eric. We have Shri on to discuss that. And, of course, next week we'll be doing the big campaign where all of this will come up. We're going to talk about some of in a really frank way, have people on are going to talk about the challenges we face, and then importantly, what we can do and some solutions to make sure that we sort of secure our financial futures. So we're looking forward to that. Thanks, everybody. We'll see you tomorrow. Take care and good luck out there.
Hi. On June 5th and 6th, 2024, I'll be speaking at the largest AI event in Asia, Super AI, in Singapore, at the iconic Marina Bay Sands. Alongside brilliant minds like Benedict Evans, Balaji, and Edward Snowden, I'll be on stage exploring the extraordinary potential of AI and the profound change it represents, not just for financial markets, but for the world as we know it. With over 5,000 attendees and over 150 side events, Singapore will become a vibrant AI hub for a full week from June the 3rd to the 9th. Visit realvision.com/Super AI to register and join me with 20% off tickets with the code REALVISION, all in caps.